Daniel, a lot of our clients are solopreneurs, solo business owners that are paying, over $50,000 in taxes. So what would you do if you were in their situation to help them mitigate tax?
Yeah, it's, we work so many of these clients that we're starting to see common trends. So what I'm going to do is I'm going to just create a visual of like, hey, this is what I would expect a entrepreneur or solo business owner to do or needs to do in order to be successful on the tax and accounting side. So number one, and some of these are going to be obvious and that's good, like check the box. So solopreneurs, let's just say they do services, right? Because real estate's very different. So totally different approach. But let's just say you do services and you're making really good money. The first thing you want to make sure you do is obviously get an LLC. That might seem generic, but we've had contractors that are making $500,000 to $600,000 and they're talking about being an S-corp and they don't even have an LLC. So get your LLC. And you want to make sure you're the sole owner. So just be 100% owned where you're the sole owner. The reason why is because there's what's called a default tax status. So what that means is you're going to be a Schedule C on your tax return, but it keeps things simple. The next thing, just make sure you get a business bank account. I know this seems really generic, but it is really annoying when somebody commingles with their personal funds. It is horrendous when you're trying to report everything on the tax side. Not only that, it prevents you from doing really accurate tax projections and strategies to mitigate your taxes. So now that you have those two, everything should be centralized. So centralize all activity that has to do with your business in this business bank account. It's okay if you have a credit card as well. Just make sure they're both associated and mainly focused on your business. 3 is get QuickBooks Online. Just start with Simple Start. That's what I would do. Just Simple Start version. Don't get payroll yet. Just get it in there. And then link your banks and credit card to them, and it'll be able to pull those transactions. After that, if you're not sure how to do the books, get a bookkeeper. So that would be the next thing, is just get a bookkeeper, start doing that. Now, we can offer that. Obviously, we have a bookkeeper in-house. You're running your business pretty straightforward. It should be pretty simple. Now, number 4, let's just say you're making good money. What can we do further? Well, we need to look at, one, we need to consider an S-corp. Now, I'm sure anybody that is a solopreneur making good money has heard S-corp, S-corp, S-corp. It is always, suggested. But an S-corp comes with a lot of responsibility, which includes you have to have good books. That's why we say do step 3 first. Because if you're not making very good money, an S-corp's not going to save you money. But if you're making reasonable money, definitely be an S-corp. But remember, there's a requirement here, and that is number 5. We have to have payroll. So if you're a solopreneur, you got to pay yourself what's called a reasonable wage. Now, it's pretty subjective, but reasonable wage means you could pay somebody the same amount to do that job. So if you're making, let's say your net profit's $100K, do you really think you could reasonably pay someone $20K to do your job? Probably not. So we do what's called a compensation analysis to make sure it's reasonable. But what is nice about this, and the reason why S-corp is so beneficial to certain people, is that you're able to pay yourself, let's just say, $70,000 in wages, and then the other 30 is to be free of payroll taxes. It's just going to be what's called a distribution. So really beneficial. The other thing, the 6th thing I would look at is see if you qualify for QBI. QBI is qualified business income. If you do, you qualify for 20% deduction. So all of a sudden that 100,000, now you only have to pay taxes on 80. A lot of consultants don't qualify, but you may be able to still qualify if your income is within a certain limitation. So one thing to consider there. The next thing, now that you have payroll, you've done your S-corp. Now, how do you do an S-corp? We'll do another video on that, but you have to do what's called the 2553 form. You definitely want somebody to do it that knows what they're doing. Now from here, you got your payroll, you got your QBI. The 7th thing I would consider doing is a solo 401k. And the reason why is you can do a profit sharing portion. So number 8, we'll look at profit sharing, right? So you're able to take up to $22,500. Now these numbers always change. And then you could do 25% of your compensation on the employer side. So these are also other areas I'd look into. Just make sure you're efficient as possible. The next thing, number 9, is do an accountable plan. The accountable plan will allow you to do certain reimbursements. Like home office, you're actually not allowed to do home deduction from the what's called the 8829 form. That's not allowed. That's only for Schedule C's. So you want the home office reimbursement allocation done through your accountable plan, which we show how to do. And then number 10 is, after all of this, evaluate if you need to make any estimated payments for taxes, right? So if you do this, you should be in a really good situation where your W-2 has great withholdings, right? So you have good withholdings in here. You are putting money away in retirement. So you're also saving a lot because you're reducing your tax bill. You are noting if you qualify for the QBI deduction, and there's so much more. But these are probably the 10 steps that I would consider for a solopreneur that's kind of in that $50,000 tax range. If they're doing all of this stuff, they're going to be in a really good spot. Now, you don't necessarily have to do the solo. You could do a SEP, but your SEP's limited, and you can only do 25% of your compensation on the employer side. A solo 401k, you can do both. You can do an employee deferral and an employer deferral as well. So really good. That's essentially what I would say is like, hey, steps to success, and follow it through. You know, just make sure like you understand all of this, or have a tax planner that gets all of this, and you're going to be in a really good spot.